Understanding Treasury Buybacks, the U.S. government's strategy to address bond demand and increase liquidity. The U.S. Treasury Department has recently implemented a Treasury Buyback program, which involves paying off debt before its maturity date. The next few minutes aim to explore the reasons behind these buybacks, their impact on the markets, and how they could potentially affect your investment portfolio. By understanding the purpose and implications of these buybacks, investors can make informed decisions based on the overall economic conditions. What are Treasury buybacks? Similar to an individual paying off a car loan early, a Treasury buyback refers to the U.S. Treasury Department paying off debt before its scheduled maturity date. Instead of waiting for the full term, the Treasury conducts buybacks to pay off debt that is due in the near future. In recent months, the Treasury has been engaging in small-scale buybacks, with a focus on retiring older, less liquid treasuries and increasing liquidity in the financial system. Why is the government engaging in buybacks? Unlike previous buyback programs conducted during a budget surplus, the U.S. government is currently borrowing money to pay off its debt early. This raises the question of why the government would engage in buybacks if it is not generating a surplus. The main reason behind these buybacks is the lack of demand for longer-term U.S. government bonds. Financial markets have been showing signs of stress and a lack of liquidity during government auctions of longer-term debt. By conducting buybacks and issuing short-term debt, such as T-bills, the government aims to increase liquidity and make financial conditions easier for institutions. Impact on the markets. The impact of these buybacks on the markets is expected to be relatively small. While it increases liquidity, it does not inject net new liquidity into the system. Instead, it swaps assets and dollars without changing the overall balance sheet. However, this additional liquidity may drive asset prices higher in the short term. It is important to note that markets can stay irrational for longer than expected, and investors should focus on profitability rather than trying to predict short-term market movements. Considerations for investors. Investors should consider the overall economic conditions and make investment decisions accordingly. The U.S. Treasury's buyback program aims to address the lack of demand for longer-term government bonds and increase liquidity. While it may have a short-term impact on asset prices, it is crucial to focus on profitability and long-term investment strategies. By understanding the purpose and implications of these buybacks, investors can navigate the markets more effectively. Conclusion. The U.S. Treasury's buyback program is a strategy to increase liquidity and address the lack of demand for longer-term government bonds. By paying off debt early and issuing short-term debt, the government aims to improve financial conditions and make it easier for institutions to lend. While the impact on the markets may be relatively small, investors should consider the overall economic conditions and make investment decisions based on long-term profitability.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.